Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com. Today's date is October 31st, 2014. This is going to be a Forex Trading Education report, if you will, on how to anticipate what the story, the fundamental story, might be in the market before it's even written. What do I mean by that? Well, I'm going to tell you a story about two different countries, two different economies, and about their currencies. And we know in the foreign exchange market that typically a stronger country is going to have a stronger currency and a weaker country is going to have a weaker currency. That's the fundamental framework for currencies, is to have that winner and the loser. And so this story involves the U.S. and it involves the European Union. And in the U.S., we have the Federal Open Market Committee, and they happened to meet in yesterday or during yesterday's trading. And what we learned from the Federal Reserve was this, that they were going to get rid of what is called QE3. We knew that. That was all given, okay? They also got rid of what a phrase within their FOMC statement, that rates would stay the same for a considerable time before tightening. Now, they replaced that statement and said that the rates would potentially move higher earlier than expectations if employment and inflation were to move or continue on at a rate greater than what was anticipated. And so they opened up the door for tightening sooner rather than later, not a considerable amount of time. They also acknowledged that there was not a significant underutilization of labor resources. And that was a shift in policy as well, a shift more toward a hawkish Federal Reserve. And typically, if central bank is going to be more hawkish, you're going to see that currency move higher. And that's what we saw in yesterday's trading. We saw the dollar move higher because of the FOMC. Now let's fast forward to a new trading day. And this new trading day, we get some new fundamental news. And the first fundamental piece of news is the GDP coming out of the U.S. And what we know in the U.S. is that the GDP rose by 3.5% in the third quarter. Now, this was greater than the 3% that the market was anticipating, and it comes on the back of a 4.6% gain. So that's pretty strong, especially when you compare growth within the Eurozone, which is somewhere closer to zero on an annualized basis. So this is better news. Now, we also know that there was some Euro data come out, and that was in the form of German CPI. Now, Germany is the biggest country within the EU, and if their CPI is coming down, then that means that probably other countries' CPI is also weaker than expectations. And we saw German CPI show a minus 0.3% month-on-month gain. This compared to minus 0.1% expectations. And year on year came down to zero, or stayed the same at 0.8% versus 0.9% expectations. So again, this was weaker, and the EU and the ECB, which is the central bank of the European Union, they are concerned about inflation coming down. They're concerned about growth slowing. They're concerned about deflationary pressures, and minus 0.3 on a month-on-month basis is a negative as far as CPI inflation. So that should weaken a currency. So on the one hand, we have the FOMC talking a little bit more hawkishly. We have the GDP in the U.S., which comes out stronger. That's good for the U.S. dollar. Now, on the other hand, we have the German CPI come out weaker, and that should be weaker for the euro. And so we should see the euro go down and the dollar go higher. Typically, that's the story. That's the one that I'd write for the newspaper. If someone said this is what is going to happen, I'll write the story that's going to fit the fundamentals out there. Now, what exactly happened? Well, all that data came out, and I wrote a piece soon after the German CPI came out, and I said the following. I said the U.S. GDP was better than expected. The CPI out of Germany came out worse than at minus 0.3 versus minus 0.1. The EU flash estimate, that's for the total European Union, will come out tomorrow. The fundamentals should be bearish for the euro, but we are seeing a reversal higher. And then I said, And I continued by saying, technically, the price is approaching the low from last week at 126.13 level. The 38.2% retracement of the move down from the high yesterday comes in at 126.31.6 level. These are the resistance levels. Needless to say, the price action does not support the story, but ... I should have been more careful on what I said. I should have clarified my post a little bit more clearly, because the implied something and the but ... implied something. And what I was alluding to in those pauses and those was that the market wasn't doing what it should do. The story behind the price action was something different, than what I expected. And actually, other people within the Forex Live community came in and they piped in their reasons why they thought or what the story was. And some of the things that some people wrote was if you looked at the option, the expiries, you would know why. It was profit taking. It's a random coin toss Forex trading. Someone said no one expects that the euro should go down. And that the only way the euro is going to go down if the market starts to freak out about confidence within Greece. Someone called it a bear trap. Someone said manipulation from options, again options. And another person said month-end, weekend pressures. And someone else chimed in that the euro reserve is euro is a reserve currency, and there was probably central bank intervention within the euro or buying of the euro, and that's what caused the euro to move up. And all these stories or fundamental stories are all potentially true. I don't know, but someone who has to write the newspaper article, it could have been you, was writing the reasons why the euro should go higher. And I used to think the same way a lot. And then I started to think in terms of, well, I don't really know if any of those are true. Okay? The only thing I know is that GDP was higher. I know that the Fed said this, and I know that CPI was lower. And that tells me a pretty good story about the economy, profit-taking, option expiries, all those other things. They may or may not be fundamental reasons and that I can hang a hat on tomorrow. Like, there have been times when the market goes through an option expiry price without stopping, taking a breath, moving down, and I'm sure you can probably appreciate those times, okay? And so I start to think in terms of, well, what is the story? Can I write the story that may include all those other things that you shared with me by just looking at the price? And because that's what I do. I look at the price and I tell the story. Is that the price isn't doing what the fundamentals are saying, what the real story is saying, not the profit taking, but the real story. And if I have to write a different story because of that, I will. I will say that it was profit taking or whatever. But I want the price to tell me what the story is going to be before I write that down on paper. Okay, I want the price to tell me. And if I look back at this chart, this is the euro versus the US dollar. And I look back and I look at old lows here, and I outlined this yellow area way back when this low was made. Okay, why did I outline this level or this area in yellow? And it was because we had a low right here, and the market quickly moved to the upside. We had a low right here, which was above this low, and then another low which came right above, right near that other low, and then the market moved much higher. On the way to the downside, we had some news come out. The market fell like a stone through this level right here. It might have been through an option expiry right here, for all I know. And then we came up to the bottom of this area right here, came down a little bit, regrouped, found support against that level, and moved higher. So this whole thing corresponds with this right here. And then what do? We come down, and where we find support against that old low right here, because people see that. They know that that level exists, and we move sharply higher. We didn't revisit that area until way back here today. When the market came down, and what do we do first? We found support against that old low right here, right? This is after the FOMC. The story is being written. The euro should go lower, the dollar should go higher. And it's doing that. That story is being true to its word and true to the fundamentals. And then we get the market move down below this level right here. And what do? We find the buyers, and the buyers take the price. I'm going to zoom in here. And the buyers take the price back above this 71 to 84 level. And we're trading above this level until the GDP comes out, and the GDP sends a price well back below those levels. Now, ignore what happened here. Ignore the real story here, and instead look at the story right here. And the story right here is saying GDP is higher. German CPI is going to come out weaker. We already sort of knew that. This price is going lower now, and the market went below the prior low, and what did it do? It didn't stay down there. In fact, the market moved, shot right back up, and we closed this bar right up here, and we never looked back at this 71 to 84 level again, this key level that I had earmarked as a level that is important to stay below. If we go below, we should stay below that level. If we can't stay below that level, then the story is different. Something else is happening out there. It may be profit taking, it may be options, it could be no one wants to be short the euro, it could be a bear trap, it could be all those things, month end, weekend, it could be euro as a reserve currency. All those things could be the reasons why, but I want to know the reason why right here. And this is where it tells me the story. It tells me the story right there at 125.84 that this thing isn't going down, okay? And you can see that off the 5-minute chart, because if I go to the 5-minute chart and I look at the 84 level, what do I see? The price moving above the 84 level, and then I see it coming down right to the 80 level. It came down to 83 or 82 right here, and then it based, and we never saw it again. It had one little bar below that 84 level, and it said, nope. The story's changed, Greg. It isn't about the GDP. It isn't about the German CPI. It's about some other thing that we'll write about tomorrow in the paper, and that's going to be the story. And so trading can be about the story, all right? But the story is often after the fact. I want to write the story before the fact. I want to anticipate what the story will be by using the price levels, by using levels that make sense, that I can look at, and I can see the market seeing these levels. And I got to believe that the market's going to see those levels and they're going to react to those levels. And those are going to save me pips. If I short it here, it's going to save me pips because I'm going to get out above there, because I'm going to go, something is not right here. Let me get out. Let me live another day and prevent myself from having the market go up to the 38.2% retracement and stop it on the dime right there, which is where we sit right now. So we went right up to our 31.6 level, as I wrote in a post, and we stopped right there. And now we got to get back below this level, folks. We even have to get back below these low right here, but that's a different story, isn't it? My name is Greg Michalowski. Good fortune with your trading. Hope you learned something today. Bye-bye now.